Welcome back, everyone. This is our very final session for the conference, Energy Finance 2024. We hope you found the conference most insightful as well as made many valuable connections here. We have an absolutely apt topic to end and round off our three-day conference. It's entitled Uniting the Region, Inflection Points in Asia's Energy Transition. For this session, I'd like to introduce you firstly to the moderator, Sam Reynolds, IEEFA's Research Lead, LNG and Gas, Asia. Please do take the stage. Joining Sam on stage, we have panelists for the session, Sonal Agarwal, Associate Partner at EY, Julia Skorupska, the Head of Secretariat at Powering Past Coal Alliance, Aslan Mohammed Kordi, Head of Industry and Planning with MyPower, together with Namita Vikas, Founder and Managing Director of Optus ESG. All questions for the panel, as usual, can come in via the Hoover app from both people joining us today here in person as well as the virtual audience. Thank you all so much once again. Sam, over to you. The floor is yours.
Thank you. Thank you so much, everybody, for bearing with us in the final panel of the conference. I think it's been a really fantastic event so far, and thanks again for sticking around. So my name is Sam Reynolds. I lead the gas and LNG work for IEEFA's Asia team. It's a real pleasure to be joined by such a distinguished panel. And I think the goal of this session is to really bring together a lot of the things that we've learned over the past 2.5 days into one crystallized session. And we're going to hear from a really distinguished group of experts with, I think, a very diverse background. The session is called Uniting the Region, Inflection Points in Asia's Energy Transition. And it's somewhat inspired by the incredibly rapid progress that we've seen in various countries and at various times around the region toward renewable energy deployment and the clean transition writ large. Of course, Vietnam added 11 gigawatts of solar in 2020 alone. A recent example in Pakistan imported 13 gigawatts of solar panels in the first half of 2023. And although we learned yesterday that those numbers, may be inflated for X, Y, and Z reasons, I think they give us a brief glimpse into what unlocking the region's renewable energy potential might look like. So the guiding question for this panel is really, what are some of those key triggering elements that might create even more rapid progress around the region? As always, I encourage everybody to ask questions via the Hoover app throughout the session. And just a quick note that you may notice some overlap with the preceding panels and sessions. And what I want to say is that that's perfectly okay. We're here to, again, bring together a variety of perspectives and leave you with, hopefully, a set of conclusive ideas that you can really take home. So I will stop there. I'm going to introduce the panelists one at a time as they come up. And with that, it's such a great pleasure to start with Sonal Agarwal. Sonal is an associate partner at Ernst & Young's Energy Transition and Climate Strategy and Transactions Division. She works with private and public sector players to develop renewable energy strategies, including policy, procurement, capital raising, market entry, the list goes on and on. Sonal is also the co-author of a recently published study on the various barriers to renewable energy financing throughout the region. If you haven't seen that study yet, I highly, highly encourage you to take a look. Sonal, thank you so much for being here. Over to you.
Thanks, Sam, for such a warm introduction. I did not know such great things about myself. Good afternoon, everyone. Very glad to be here. Thanks to IEEFA for inviting me to this very important culminating event. We have had 2.5 days of enriching discussions, things that sometimes feel obvious, but still need to be said. And this session, what I intend to do is bring together our collective thought leadership into a discussion format. IEEFA requested me to use some slides, and that's what I'll do in the next 5-10 minutes to guide the discussion, and then I'll leave it to Sam back again. My introduction is done. What I would like to say about this region is that this region is following global trends. It is no more about doing the right thing or doing just the right thing. It is doing the right thing, and it is with a solid business case. What's driving the solid business case of renewables in this region is very aligned to what's happening globally. So it is not a region that is different in those aspects of themes that are driving the energy transition, but yes, there are nuances to this region which are very, very different from what's happening in other parts of the world. I'll use this wheel where we rank top 40 markets in the world on renewable energy attractiveness and where do they stand. We have markets like India, China, Japan that come in the top 25 because of sheer scale, regulatory maturity, opportunities that it offers investors. But then there are other markets from Southeast Asia that fall off beyond 40 or remain in the top, last part of the 40. And why is that so? So what I'll do is I'll focus and zoom in a little bit more on Southeast Asia for this discussion. Enough has been said about India in the last 2 days, so let's just zoom in into Southeast Asia a little bit more. If I look at Southeast Asia and I just correlate it to my initial 4 trends that I was talking about, is progress made in Southeast Asia? I would say yes. We do have NDC targets, conditional, unconditional, which have trickled down to national policies on energy, low carbon mobility, etc. The government ambition has been set in terms of gigawatt. Yes, we can comment whether it's aggressive enough, it is fast enough or not, but we are moving in the right direction when it comes to government ambition, and progress is happening. The government has realized that coal will not happen anymore. Some very explicitly have put a moratorium on coal-based generations, others not, for various other regions, and we had a big discussion about just transition, which feeds into this. Maybe my co-panelist, Julia, can comment about coal retirement a little bit more later in the presentations. If I look at the solid business case element of renewables in this part of the world, yes, plunging technology, efficiency of the equipment, maturity of the supply chain, regulations, etc., do feed into competitiveness of renewables versus the traditional coal and gas. I have taken an example of Malaysia because we are in Malaysia, of how this has really helped dive down the prices of solar in Malaysia. So Malaysia, for those who do not know, run a large-scale solar tender annually, typically annually, and they have run 4 such tenders. The 5th one has recently received the bids. The results are not out yet. But over the 4 tenders, what Malaysia has observed, that the prices have gone down by about 57% from the 1st one to the 4th one. We expect improvements in the 5th one. Year on year, that means a 15% drop in solar prices in Malaysia. I'm not talking theoretically assumed LCOEs. I am talking the real prices that were submitted, and that's what the PPAs were signed at, right? This shows us it's possible if you provide the investors with right signals, and I'm sure Aslan is very happy to hear that the market is definitely, most definitely providing those right signals to achieve these results. So there is a solid business case that is to be exploited by investors. Another lever that's driving this transition globally and also now in this part of the world, and we can debate about the progress, is our corporates. So the corporate action on sustainability, the corporate action on scope 1, 2, 3 emission reduction, et cetera, is driving this transition. A sector that was heavily driven by regulations and government targets is now becoming a consumer-based sector, where consumer demand is driving action, and that's what the corporate PPAs are about. Now, we can look at Southeast Asia and say more can be done. I agree, but stuff is being done. We spoke about direct corporate PPAs in Vietnam that have now been approved. We are still waiting for implementing framework. We have options available in the Philippines in form of Green Energy Options Program, where corporate PPAs can be done through the retail electricity suppliers. There are options explored in Singapore to enable that through import tenders. In Thailand, certain form of offsite PPAs are allowed, etc. So progress is being made. Malaysia has recently allowed CRES, which is Corporate Renewable Energy something supply scheme, and CGPP, which is Corporate Green Procurement Program. So progress is being made in certain markets, but not probably at the degree that we want it to happen and at the speed that we want to see. And then the last one that I want to speak about is the growth outlook and the risk-return profile, right? That drives investments, that drives deployment of renewables. We often talk about Asia as a region or Southeast Asia as a region to simplify conversations or to bring bigger themes into picture. However, each of these markets are nuanced by their own feature. The entire region in Asia is quite diverse and disparate in terms of resource allocation. There are markets that are rich in both solar, wind, offshore wind resources. There are markets that only have solar. And then there are other markets who also have geothermal. So that resource disparity guides the pipeline, the availability, the size of opportunity in these markets. Similarly, the electricity market frameworks are very different. We have open markets like the Philippines and Singapore, and we have extremely monolithic market with legacy frameworks still in place. For example, Malaysia, Indonesia, etc. So they drive their own set of opportunities and risks in those markets. And accordingly, there are challenges that need to be overcome in terms of managing them. There are common themes, again, as part of the region, Southeast Asia or Asia, example, land acquisition or long permitting, etc., which of course needs work. But then there are certain nuances of each country in terms of their currencies, in terms of financing availability that still needs addressed for the progress to be in a speed that we want to desire. With this, I will stop and refer you to the study that previously Sam mentioned about, where I deep dive into challenges of each of these specific markets if you're interested. But I'll hand it back to Sam and talk to you again in the Q&A.
Thank you, Sanal. The study that she refers to is very clear that each country is going to require its own unique solutions, and here I asked her to generalize, so thank you. Next, I'd like to introduce Aslan Mohd Kordi. Aslan is the head of industry and planning at My Power Corporation, here based in Malaysia, under the Ministry of Energy Transition and Water Transformation. My Power was formed, I believe, to study and help organize power sector reforms in line with Malaysia's economic goals. Mr. Kordi leads the agency's work in enhancing competitive electricity procurement in peninsular Malaysia, which involves charting out roadmaps for the evolution of the market. And we're so fortunate that he was able to join us on such short notice. So please welcome Mr. Aslan. Thank
you. Thank you, Sam, for the introduction. And thank you, IEEFA, for having me here. And good afternoon, everyone. So I think let me begin by first introducing My Power, as I don't think we are well known. You certainly won't find us on Google. So My Power is an agency under PETRA, which is the ministry responsible for energy transition and water transformation. Our role is to plan and drive power sector reforms in Malaysia. So we're not like other agencies where we are in operation continuously. We were activated and then made dormant and reactivated again. So this is in our third version or resurrection, if you will. It was first established in 2010. So the generation segment of the Malaysian market was liberalized in the early 90s. So we saw the introduction of independent power producers. So in 2010, the government has commissioned the study and decided that from that point on, the first wave of transformation would take place for the power sector reform in Malaysia. So you can still see the effects of those reforms, but more interestingly, those effects are largely unchanged even after 10 to 15 years. So whether that's the right thing or not is a question, right? So from that first wave of transformation, you could see the introduction of incentive-based regulation framework, which is the economic regulation framework that we use to set rates for Tenaga, the utility. We also could see the functional unbundling of departments within Tenaga, which are the single buyer and grid system operator. They are still ring-fenced, so essentially their paymasters are still Tenaga, so that raises concerns between the independence of these entities. And then we also saw gas prices rationalized during this period. It was initially set at a fixed level, very attractive for power generation developers to come into the market. But then it was rationalized to the Malaysia reference price, which is the benchmark market price set by Petronas. Initially, for a brief period, we introduced competitive bidding. So from 2012, maybe a couple of years after that, 8 award decisions have been made. And 3 decisions were made to renegotiate the existing PPAs. But after that, it reverted back to status quo. Later, my power was made dormant in 2015 maybe, and it was reactivated again in 2018. It was supposed to carry out the remaining reform work envisioned under the first wave of transformation, but due to various conditions and political climate, it was made dormant again, and then reactivated in 2021. So under this version, we did a new study called Future-Proofing MASI, and I'm going to talk about it later. I think at this stage, maybe I should give you a brief overview of the Malaysian market. So the Malaysian market is largely a single buyer market. We have some competition in the generation segment, but the rest of the value chain is largely either owned and operated by the incumbent state utility, Tenaga, or it is largely dominated by the market. So for example, in the retail segment, we have a small portion of the market served by an independent utility in the Kulim area in the northern part of the peninsula, but largely it is all dominated by TNB. Our generation and capacity mix is still dominated by fossil fuel generation. So 45% of the installed capacity is via coal, 40% is gas, but because of the coal's baseload nature, around 50%, 55% of the gen mix is contributed by gas. 35 to 40% is contributed by, 55% is by coal and 35% by gas. Our solar, we don't have much renewable energy potential except solar. So our solar is still small relative to the capacity mix. Maybe total share in the generation mix is around 1 or 2%. We have hydro, owned by Tenaga. I think we have exhausted all big hydro potential in the peninsula. There's probably some small mini hydros left, but they are all owned by Tenaga, inherited from its time as a government entity. We have, as Sona has shown in the presentation, we have a target of 70% installed RE in the capacity mix by 2050. So that is probably 65 to 70 gigawatts by 2050. We have kind of like a market called NIDA, but since the capacity participating in that market is just less than 1%, maybe 0.5%, so the market is not liquid at all. They are all price takers. They are envisioned to be kind of like an energy-only market that you see in Europe, for example, but since its establishment, because we continue to have PPAs, because the PPAs continuously being awarded, then there is essentially no point in participating in the NIDA, especially when you can't recover your fixed costs, right? Because you are only recovering your variable costs. So, as I said, back to my question before, where do we go from here? So should we remain status quo? Because if you ask the regular consumer, nothing is wrong with the electricity supply in Malaysia. They are enjoying good tariff, reasonably priced tariff. Supply is reliable. Unfortunately, the average consumer doesn't really feel the need for sustainability. So why do we reform, essentially, right? So in order to ask that question, we have to understand how we see the power sector, right? So the power sector, from my power's perspective, is that it is an important enabler for energy transition, and at the same time, a strategic lever for economic growth. And this is where my power work, which we term the future-proofing MESI, comes in. And under this future-proofing MESI, we have recommended to the government 10 initiatives under 4 reform areas. So the first reform area is governance. And under this area, we aim to enhance coherence of national policies and action plans. Planning, which means having the agility to design for growing complexity of demand and supply. In the industry reform area, we aim to have fairer allocation of risks for optimal economic efficiency, and tariff with the objective of ensuring social equity and efficiency in pricing. So these reform areas come about when we see problems in the current electricity supply industry. So as you may know, we don't have an integrated ministry for energy. So some of that jurisdiction comes under Petra, but gas matters rest under the Ministry of Economy and the Prime Minister's Office. And there's always this constant friction between these two ministries and other ministries as well, because each ministry has its own objectives and targets. And following the trends in other jurisdictions, the growing synergy between gas and electricity needs to be incorporated in electricity system planning. And as for the planning, a poor planning will result in risking your system security. And with the growing renewable in the system, you also risk using your assets inefficiently because of that intermittency. And we also see the market as an important enabler because it will function as a platform to enable new business models and also new technologies. So if, for example, you have a grid-forming inverter that you want to enter into the Malaysian market, I don't think you can. If you have battery, you also have a lot of barriers to entering the market, so you want to enable those business models. And ultimately, the consequences will be faced by the ratepayers in terms of tariff. So ensuring that the tariff is allocated fairly, while at the same time targeting assistance towards a vulnerable group is important. I think at this stage I will pause here and hand over to Sam. Thank you very much.
Wonderful. Thank you so much, Azlan. Our next speaker is Namita Vikas. One moment, let me bring up her bio here. It's long. Namita is not only the founder of Octus ESG, which is a global expert advisory firm for sustainable development. She's also an award-winning business leader, several decades of experience across banking, finance, technology, and others. Namita has pioneered several green and sustainable banking products at both the wholesale and retail levels. And in her previous roles was instrumental in raising about $1 billion in green capital from global development finance institutions. I could go on, but I won't. And so, Namita, the floor is yours. Thank you.
Thank you very much, Sam. That was very elaborate. And thank you, IEEFA, for inviting me here. Much has been said about sustainable finance, requirement of finance over the last 2.5 days. And I was trying to put my thoughts together in terms of not being repetitive. I think meeting the investment gap is something that needs to be looked at from uniting the nations or uniting the region perspective, I would say. And if I just zoom out a little, I would think that, and my earlier panelists and all those who spoke over the last 2.5 days did highlight the fact that rapid economic growth, urbanization, and industrialization in the Asian continent has surged the overall energy demand. It's at about 80% since the 2000s. And for Asia, well, it's been at the forefront of the global energy transition, but for it to meet the 33% regional target, it requires $1.5 trillion US. Most of the Asian countries, I think 8 out of 10 countries, are targeting carbon neutrality between 2050 and 2065. But investments are not on track if you look at that against the transition work that's happening. And investments in Southeast Asia on clean energy, if you compare that with the global investments, it's at about 2%. Annual average energy investments over the last 3 years were at $72 billion. It should be at about $130 billion as per International Energy Agency's announced pledge scenario by 2030. So there are gaps. And then, there's another challenge that we are standing at crossroads, if I may say, decoupling of economic growth and carbon intensity of carbon emissions. I think that's been a huge challenge for Asia, which accounts for about 60% of the global emissions. For countries like India, China, Indonesia, Vietnam, Thailand, they've set ambitious targets to be advanced economies between 2025 and 2047, and the next 10 years would see bulk of emission growth, accelerating burning of coal and high consumption of fossil fuels. That will come with, increased demand does come with cost of increased usage of consumption of fossil fuels, where the whole energy mix is a little tilted towards more of coal, oil, natural gas. At the same time, the demand for renewable energy is also surging. We've seen how China has surged forward, India with its own numbers. I think pathways for energy transition have been emerging, and there is quantum of capital that's coming to the fore, but not at the level of the scale or the bankability that needs to be addressed. And towards that, I would think there are 4 or 5 measures essentially that needs to be looked at, because we're saying that this whole 2.5 days needs to culminate into something solid for all of us to work towards. I think, prioritizing on streamlining of regulations and improving grid infrastructure, I think that's one of the key areas that needs to be looked at. From a decoupling standpoint, a planned strategy is required across the region to phase out coal power. And we were in earlier conversations in terms of how do retiring of coal plants or repurposing of coal plants would really look like, because we need a solid plan at a regional level for this transitioning. Just transition, fair and just transition, is a big challenge for countries like India, where there's so much of organized as well as unorganized workforce that's a part of this whole sector. And therefore, there needs to be really solid measures, alternative retraining for these folks. And I think one of the other points is decarbonization within industries which use energy and which need to be more efficient. So how do we look at, energy efficiency measures, electrifying operations, adopting low carbon technologies, which from a banking perspective is a big high risk because technology upgradation happens every 2.5, 3 years. And therefore, how do you invest in technologies becomes that much more important. Learning from the global north, also south-south corridor learning, I think all that becomes very, very important. And finally, a topic which is very close to my heart, and that is mobilizing finance and investments. You know, given the quantum of finance that is required, it's not just about public finance, but how do private players come to the fore? I'm sure there's many discussions that happened since yesterday in terms of investor behavior, financial behavior as to how this capital can be deployed. But I think it's important to understand those challenges and work around those challenges. Given the geopolitical tensions, the macroeconomic challenges, the natural tendency is to pivot towards conventional projects where the risk-return models are all proven, where the perceived risks are low. And if you look at large projects, utility scale, or even if you look at decentralized, I think challenges around the increase in cost of capital due to, say, inflation or the low rate of interest or the long gestation periods, which simply don't match with the lending horizons of financial institutions, and therefore these projects or even the weak capacity of developers. I mean, there are gaps from the time a PPA is signed to a financial closure, and then there are moratoriums, and then who's going to bear the cost of all of that, right? So that just escalates the costs in terms of projects. Financial institutions may not have those kind of risk appetites, investment criterias, and then tendency to go towards conventional sectors really kick in. We heard a lot about innovative financing strategies. I think they address market failures, institutional barriers, and shape scalability. However, they've not grown to that level as it should be versus the demand, I would say. I mean, we've heard about blended finance or asset securitization that have helped in mitigating or better allocating risks in that sense between the public and private sector, or green bonds, sovereign funds. Right now, there's no greenium on green bonds, so issuance is a little slow in developing markets particularly. Municipal bonds, I mean, a great example, because ultimately it percolates down to from a country to the province to the local folks, right? So I think municipal bonds have picked up well, where it's unlocked capital from multilateral development banks, private institutions, like even pension funds have been putting in institutional investors. I think we need more of that. Convertible debt structures are another mechanisms to improve access to local financing and build the entire local lending capacity. I think we spoke a lot about yesterday on the currency risk, and hedging mechanisms become critical. I think there needs to be some kind of pathways to draw in I mean, there is this whole conversation around the G20 of the role of multilateral development banks and how that needs to evolve. And I think what we need to look at a core agenda from a transition standpoint. And when we talk about energy transition, while renewable energy as a sector has a good flow of investment. I mean, today we think of that also as a mainstream sector from a banking lens. Energy storage systems, technologies that provide transition, carbon capture, so on and so forth. I think these are still models which need to evolve. And they form this whole energy transition ecosystem, cannot be left out. And I think those policy mechanisms towards supporting those kind of projects is something that we need. I'll stop here. Thank you very much.
Thank you so much for those thoughts, Namita. Really interesting to hear. I'm sorry to move quickly here, but I want to move just to make sure we've got enough time for Julia. Julia Skorupska, I'm really pleased to have on this panel. She is the head of Secretariat for the Powering Past Coal Alliance. And just for those unfamiliar, The Alliance is an initiative launched by the UK and Canada in 2017 that aims to phase out unabated coal in OECD countries by 2030 and non-OECD countries by 2050. The membership seems to be increasing all the time, but I believe it now has over 160 members, including 50 national governments, along with subnational governments and financial institutions with over $17 trillion of assets under management. So Julia, over to you. Thank you so much.
Thank you very much, Sam. I have some slides as well, so I'll just get them up now. Great. So, good afternoon, everyone, and thank you very much for listening to me. I wanted to pick up one of the key points that Namita had mentioned about the importance of planning for a coal phase-out in this region, and in particular for planning for how we're going to finance the coal phase-out. So to start off with, why is this issue important? So you can see here in this slide how important phasing out coal by 2040 in this region is going to be. So you can see here the projected cumulative emissions from existing coal power plants, and that's going to use up 2/3 of the remaining carbon budget if they continue to operate as planned. And with the green and the blue bits, you can see the bits which are in this region, and you can see that that's the overwhelming majority of projected emissions from coal power plants. So really, getting on top of this challenge in this region is going to be make or break for 1.5. But it's not only make or break for climate reasons, it's also really, really important for prosperity in the region. So the IMF estimates for every dollar that we invest in accelerated coal transitions and accelerated transition from coal to renewables, there's a $3 return. There's a really strong economic case there. And in part, that's about the avoided climate costs. That's the kind of majority of the costs which are included in that IMF estimate. And those avoided climate costs are going to be particularly important in this region as well. So if you look at the IPCC estimates for economic impacts of climate change and look at their intermediate scenario, which is pretty much the kind of do-nothing scenario, then they estimate that there will be a loss of 5% of GDP in East Asia and Pacific, and that's much higher in South Asia, where they're estimating a loss of 15% of GDP on that do-nothing scenario. And we've already heard from many of the speakers about the economic benefits of switching to renewables as well, with the falling cost of renewables and the potential that the switch creates for developing new industries and new forms of prosperity. But despite this kind of really clear benefit, we're not on track for phasing out coal on time. So we often hear that kind of a first principle of economics is that you don't leave money on the table, but this seems like an issue in which we really are. So you can see here the gap in Southeast Asia between the current projected, the STEP scenarios, that's the IEA scenario, kind of what's being done under stated policies, and where we need to be for 1.5, which is the bottom line on this scenario. So there's a huge gap there. And why is there this gap? I mean, obviously, it's not for no reason. It's because there are real challenges to the coal transition, particularly in this region. So the IEA has come up with some really kind of useful ways of thinking about some of the obstacles to transitioning out of coal. And they've come up with this Coal Transitions Exposure Index, which brings together considerations around economic dependence on coal in the energy system, dependence on coal for jobs, and also the level of lock-in through things like long-term power purchase agreements for coal power plants. And we can see in this chart that the places which are going to find it hardest to exit from coal, many of them are in this region because there's a broad kind of range of a kind of coming together of these factors, which is going to make it hard to exit coal. And overcoming these challenges is going to require significant investment. So there's obviously, and most importantly, the system-level investments. So the investment in scaling up alternative renewables is obviously kind of one of the most important things that we need to be doing here, and one of the most important costs. There's also going to be costs in upgrading the grids, costs in making sure that we deliver a truly just transition. Alongside those system-level costs, there are also going to be asset-level costs. So the costs of either repurposing the existing coal power plant assets or the costs of retiring them if there are long-term contractual arrangements that need to be exited. So kind of what are the scale of those costs? I mean, it's very hard to know. There are no real clear estimates of those. But the IEA estimates that emerging markets will require between $2 and $2.8 trillion of investment in clean energy by 2030 to deliver a 1.5 degree aligned transition. And on the asset level, I mean, I think it's even harder to work out what are the costs, because a lot of that depends around kind of what the policy environment is as well. But the IEA says there's currently $1 trillion of unrecovered capital in existing coal power plants, and 35% of that is in emerging markets outside of China. So I think on both of these kind of measures, we're looking at significant costs. And we've seen and we've heard about during this conference some of the promising developments, particularly at addressing some of the costs around the asset level, retiring and repurposing. So we heard this morning from Irene talking about the kind of really exciting work which has been done by ACEN to think about how they would retire their coal power plant early. So we've also heard about the kind of initiative also, which I think Irene mentioned this morning, the Traction Initiative from Singapore, thinking about how credits could be used to bring that retirement date even further forward and how that could be sort of generalized across the region. And I think many of us have been following with interest the Asian Development Bank initiative to try and retire the Cirebon 1 transaction early. But why do I think this is an inflection point? So there are these pilots, there are these kind of promising initiatives, but it feels like we haven't yet got to lift off, that we need to kind of massively scale this if we're going to deliver the transition at the pace and the scale required. And I think there are some key challenges that we're facing to scale finance for coal transitions, and in particular to scale finance for this kind of asset level costs around retirement and repurposing of coal-fired power plants. So I think that investors are probably rightly concerned about risks around moral hazard and what are the overall decarbonization impacts of these investments. So can they be sure that if they invest in retiring this coal power plant, another coal power plant isn't going to be built that will kind of take up those emissions, or we're not going to incentivize people kind of not closing coal power plants because they're waiting for a payment. There's also insufficient policy support. We've heard this so many times during this conference for renewables, and a lot of these kind of making these transactions work depends on there being alternative forms of energy. And finally, I think there's quite mixed signals at the moment on transition finance. So I think that there's still strong kind of groups calling for divestment of coal assets. So we're really clear that you shouldn't necessarily be looking to divest from all your coal assets. It's really important that people are investing in a managed transition out of coal. And I think for investors as well, a lot of them worried about the fact that a lot of the metrics that they're using to report their climate finance against are backward looking, and so they're bringing more carbon onto their books if they're investing in these transitions. So it feels like this is a problem which is kind of a problem at both policy level, but also at finance level, kind of bringing together public and private finance. So it's a problem which it feels like genuinely, as this kind of session says, is only solved by bringing people together. So I wanted to finish by telling you a little bit about the work we're doing at the moment to try and do just that and bring together the key stakeholders to think about what would be a way of trying to start to resolve some of these problems. So I wanted to talk a little bit about the Coal Transition Commission, which is an initiative which was launched by President Macron in the presence of other leaders at COP28, and it's now co-chaired by France and Indonesia. The idea is that it brings together governments, public and private finance, to think about how could we scale finance for coal transitions. And as I said, this is a problem which is going to involve action on a lot of levels. So we're thinking about recommendations in 4 areas. So first, recommendations on what sort of policy environment is necessary to encourage investment. So what is it, where are government's responsibilities lying? Probably in having kind of clear no new coal commitments to give people the confidence to invest, transition plans that set out what the direction of travel is going to be. Secondly, we'll be looking at delivering proposals around kind of what is the scale of finance which is necessary, and what should we be thinking about around public finance for this area. Thirdly, as I've said, kind of the risks are one of the key areas which put off investors. So I think key to be kind of developing really sort of robust guidelines about how to manage those risks, but then also for regulators, taxonomy creators, to then be very, very clear that if things are done within these guidelines, then they will be counted as climate finance. And finally, maybe one of the biggest challenges that we have at the moment is trying to get the kind of pipeline of projects going, trying to find places where people are interested in taking coal power plants off early, and kind of where this really will make a difference and which could be scalable in different contexts. So the third area we'll be looking at is how do you develop that pipeline? How do you work with governments to think about which coal power plants, or how they come up with an overall sort of national level plan? So those are the areas that we're looking at, and we'll be working to come up with some initial recommendations in the run-up to COP this year. We'll be coming out for kind of public consultations before COP and where we've got to. But I kind of wanted to finish by saying this is obviously a room that has huge expertise on this subject. And so we're really keen to be hearing from you as to what do you see some of the key challenges as being in this area, and what are the areas that this sort of body should be looking at for solutions. So we are really keen to hear from everyone here. Thanks.
Wonderful. Thank you all so much. It was really a lot. You know, we heard from an investment perspective, we heard from a regulatory and power reform perspective, a finance perspective, as well as you know, a coal phase out and transition perspective. So thank you all. I guess what I want to try to do with some Q&A is try to bring together some of what you've all said. And Aslan, maybe I could start with you. You know, we saw in Sonal's slides that the large-scale solar auctions have resulted in very large declines in the prices that are being discovered. Can you maybe touch on a bit more of what you see as a successful, you know, the reasons for success? Yeah.
Thank you, Sam, for the question. So in Malaysia, there isn't a lack of interest from industry developers in developing solar. I think despite that, the barriers to entry is still prominent. We don't have a ready market that can incentivize and give the appropriate signals for the organic growth of interest. It has to be driven by government, via programs, and therefore there are limits to what the programs can do. We still have quotas for each program. The grid still is facing limits to the penetration of renewable energy. So despite all those odds, we can see very encouraging trends in the LSS auctions. I think the government has in the past tried to encourage rooftop solar. So there seems to be some kind of innovation in that sector. For example, should we then allow households to lease their rooftop space? Should we then allow these households to export their power to the grid as opposed to netting off under an NEM or using it for their own consumptions and the Celco? So that's an encouraging trend, and the work that My Power is doing is try to reduce the administrative burden of the government and let the market provide that platform to encourage participation from these renewable energy developers. Yep.
Thank you so much. And Namita, I mean, maybe to pass that, a similar question to you is, you know, you talked a lot about different priorities for financing, but I'm curious to hear maybe some more thoughts from you about what policy drivers you think are critical into facilitating the capital flow.
Thanks, Sam, for that question. You know, while I was hearing Julia, see, if you look at just from a policy standpoint, phasing out of coal subsidies would unlock about $1.3 trillion. And then that capital can get navigated towards providing, concessionality in that sense for thematic bonds or creating more of an energy transition bond market, enhancing that market. Or it may also navigate traditional investment into these kind of investments. I mean, I just want to give you an example. You know, earlier on in India, we had a coal cess. And that coal cess that companies paid would go out to a climate action fund. Unfortunately, that fund got submerged under our GST, some taxation norms. But I think we need such large public level interventions to then get private capital in. I think that's one. Second is strengthening of financial markets and capital markets is extremely important to improve the capital allocation and the resources that are there. Flowing through from that, I think I didn't hear this, I may have missed out, but I think we need green tax. We need unified standardization across the region, right? So green taxonomies, implementing carbon pricing at a country level, at a regional level. I think this is going to bring in more of private sector to come to the table because it needs to be looked at from a business sense standpoint, so mobilizing private capital. Policies that support public-private partnerships, policies that look at or encourage pay-per-service usage, like he spoke about from a decentralized energy deployment perspective. And I think one of the last points I want to make is on tax incentives and regulatory frameworks that would support through impact investment policies. I'll just give you an example. Again, I'm taking an Indian example because I'm a banking practitioner in India. I was a part of the institution where we issued the first green bond for India, maiden green bond for India in 2015. It's not that we had a lot of love for green, and I'm being very open and frank about it, but it made business sense because the regulator gave in certain tax exemptions on infrastructure lending, and that made sense for us to go and issue a green bond. So I think, we need those kind of measures. I mean, I think Singapore as a country has put out certain measures. India is in the process of putting out some more measures. But I think tax incentives and some kind of exemptions like this will be able to curate the market. So if you look at, just one final point, if you look at the renewable energy stack, I have been involved since 2007, 2008. If you look at that stack, it started with philanthropic capital that went in. So any sector to, expand, it's philanthropic capital, then came the subsidies, on that came equity impact investment, provisions like this, that got large-scale commercial debt, and that's how the sector has grown. So I think as I said, energy transition ecosystem, this is what we need, and we need policies that would look at these kind of aspects. Thank you.
Thank you so much. One of the things that you mentioned very early on in your presentation, Namita, was the importance of grid financing and getting that going. And I want to just pass this buck over to Sanal. And you talked about a lot of the policies that might favor renewable deployment. But oftentimes the places where the resource potential is away from the demand centers. And so how can you get that grid financing going in parallel to some of the RE developments you talked about?
Yeah, that's a very pertinent question when you talk about energy transition. So one point I would like to make is as important as the energy transition is, it's also important to ensure that it's not chaotic. It is managed and it is orderly. But at the same time, are we scared of this topic? Are there enough, is there enough evidence for us to make it managed and orderly in our markets? There are examples of cases where it was chaotic. For example, what happened in Australia with the sudden boom of rooftop solar. There are lessons to be learned, which this part of the world can pick up and make it managed. It's a case of proper planning to the point where your grid can take it orderly, and then investing beyond that point to ensure that the energy security and reliability is managed, right? So now investments in transmission are equally as important till the time we exploit the existing capacity of the grid to manage the intermittency of renewables and manage with battery storage, etc. This financing could come at project level in markets where the framework allows and transmission is privatized. In markets where transmission is still not privatized and relies on the state-owned utilities, greening the finance would be the lever to encourage that. So allowing for sustainability financing frameworks of these SOEs, helping them align with those KPIs and taxonomy to tap on investors, whether they are impact investors or whether they are DFIs, et cetera, with the agenda to progress energy transition would be the lever to invite that investment in transmission.
Excellent, thank you so much. So now you also presented quite a bit about corporate PPAs, and I think that's an especially pertinent topic, considering the importance of organizations like RE100 and initiatives on that end. And I guess that brings me to a question for you, Julia, given the wide reach of your initiative, the PPCA. And I'm wondering how, and I share this question with someone on Whova who asked it actually, is what does the PPCA and the commission that you were talking about, what do they do for monitoring and enforcement of some of their membership, and what tools can they use to make sure those goals are seen through?
Yeah, I think it's a good question. So with our national government members, we kind of monitor what they're doing through our coal countdown website. So you can see there that we kind of provide regular updates at how our national members are progressing with their coal phase out. With financial institution members, I mean, I think one of the things which has shocked me coming into this as someone from a government background is just quite how seriously they take these commitments once they make them. They really do seem to kind of monitor themselves, and I think they're very aware of the civil society monitoring out there. So I think that making sure, and I think it's a message that we regularly have for our government members, that the more kind of concrete you can make this, the more certain, the more that you will be able to mobilize other actors. So I think there is a bit of a sense of sometimes governments say things and they don't deliver it. So what can you do to really give people that sense of this is going to happen, that certainty that this is going to happen, and then that will help you to mobilize the investment and the kind of cooperation from companies that you need.
Thank you very much. It looks like we're running towards the end of the panel. And in the vein of giving the audience conclusive thoughts, I mean, I thought I would just go down the line and ask you for one or two key takeaways that we can leave people with. Yeah. Do you want to start?
Yeah, sure. If I have to sum up what needs to happen for the energy transition, I think in a very simplified but not trying to trivialize the subject, I would say acceleration is the word that comes to mind. So progress is being made, but is it enough to the goal that we have in terms of temperatures, etc.? And that acceleration needs to happen on both sides. It needs to happen in financing the green. So you need to finance the green, and then it also needs to happen in greening the finance. So ensuring that the capital is incentivized enough to flow towards the right topics.
So I'd echo Sonal that acceleration needs to happen, but I suppose my optimistic thought is this is an area where there is a really clear economic case for acceleration to happen. There's kind of very accessible alternatives to coal now, and given the sort of developments we're seeing in the region, it feels like we're on the cusp of seeing a kind of real inflection point towards acceleration. But to really achieve that, I'd say this is an area where we do need to kind of urgently come together and build the framework which is necessary to really mobilize finance.
My message is probably more suited to the local audience. So I would urge everyone to embrace the opportunity. It's not going to be trivial. It's going to be very challenging, but there will be a lot of opportunities as well. If you see the reform work that we are doing being rolled out after the necessary government approvals, please don't be shy. Come to us and talk to us. Please explain what are your concerns and help us to de-risk them if we can. And hopefully that will also enable greater collaboration with the global audience. Thanks.
I think for me, the inflection point is to unlock capital for energy transition, and the two words that come to my mind is scalability and bankability, as I mentioned earlier. I think we need to look at long-term and short-term. In the long term, I would say that, for the long term, I think right now putting together certain unified standards, green taxonomies, would help in unlocking capital because they will bring in some kind of uniformity in terms of how financial institutions look at capital at one level. And at another level, I think we need to take smaller challenges to be solved for. That would be very, very key to looking at how we unlock the capital that's out there.
With that, I think we will conclude. Thank you all so much. Please join me in a round of applause for our speakers. Thank you.